Early in last month, we crossed up through that momentum channel. Price wasn't making a new high. It wasn't back above the 35 level. But in the 34s, momentum said, I'm out of here. Boom. Got up to 37 now recently. So it's broken out. That is the beginning of what I think is likely to be a couple quarter long, 5 or so months of upside, and likely to be very aggressive. Similar behavior occurred back in 1979 when silver exploded to 50. Also in 2010, the $25 to $30 level before silver exploded to 50 again. We argue this time this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I call them idiot highs because really you didn't spend any time up there. It was like phantom. It's like a day or two. Thin air.
Oliver begins by revisiting the precious metals market in 2023 and early 2024. Gold, silver, and mining stocks had all been in what he describes as a pause mode for several years. Silver and mining stocks were caught in a downward staircasing pattern, correcting repeatedly, while gold mostly moved sideways, capped around the $2,000 level. But in March 2024, Oliver issued a renewed buy signal on gold, silver, and the miners. That signal, as he explains, was based not on conventional price charts, but on his proprietary momentum charts. These revealed a structural foundation forming beneath the surface, invisible to most traders relying solely on price action. Sure enough, silver responded dramatically, jumping from $25 to $26 in March to over $32 in May. However, this rally was not linear. Silver fell sharply afterward, rising again in October 2024 to a new high of $35, then dropping once more. By March 2025, silver again hit $35 before suffering a panic-driven sell-off to $27.50 cents in April. This sharp drop, driven by fear that silver would follow equities down, proved false and short-lived. Within 2.5 days, silver rebounded above $30 and has now stabilized around $37. According to Oliver, this choppy movement wasn't random. It represented a long corrective pause, a violent yet necessary consolidation, not a breakdown, and it set the stage for what comes next.
Ran up last year in 2024, early in that year in March. We put out a major renewed buy signal on gold and silver and the miners. Renewed meaning that for prior couple of years they've been in pause mode. Silver and the miners had been staircasing down in corrective mode. Gold was going sideways basically, capped at around 2,000. We said back in March of a year ago that we're going to take off again. And sure enough, they did. Okay. Silver actually at one point in that rally outpaced gold pretty nicely, but it didn't last, okay, in terms of relative performance. Silver ran up in May of 2024, in other words, a handful of months after our signal, and got up it was, at our time of our signal, it was $25, $26. It got up to $32.70 a year ago in May, okay, and dropped from there. Came up later in October, got to $35, new high. Gold was going sideways during the time. Dropped again, went back up in March of this year again to 35. And that's when they had that panic sell-off into April, where investors wrongly thought that if the stock market goes down, silver must go with it. Gold didn't drop much during that time, but silver was punished severely. We know that, went from 35 to 27.50. Much of that in 2.5 days. Then it exploded right back over 30 and has worked its way up. Now we're at 37, either side of 37 for the last several weeks. That process in price where we basically, you could draw a line sideways from May of last year through a month ago. We've been above it and below it, but basically just violent oscillations. So it was really sideways. That was a corrective pause in price. And for momentum, our long-term momentum, it had a corrective pullback, where on the momentum chart, you could see a tube where momentum readings just kept zigzagging but downside in this very clear technical tube, parallel channel. in June, early in last month, we crossed up through that momentum channel. Price wasn't making a new high, wasn't back above the 35 level. But in the 34s, momentum said, I'm out of here. Boom. Got up to 37 now recently. So it's broken out. That is the beginning of what I think is likely to be a couple quarter long, 5 or so months of upside, and likely to be very aggressive. Similar behavior occurred back in 1979 when silver exploded to 50. Also in 2010, the $25 to $30 level before silver exploded to 50 again. We argue this time this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I call them idiot highs because really you didn't spend any time up there. It was like phantom. It's like a day or two. Thin air. I think by going through 50, which is not technically important for us, but it is for anybody looking at it as a stupid price chart, it's all-time new high. In real dollar terms, if silver were to match those $50 highs, it'd probably be $300 an ounce. In real dollar terms, underlying decay in the money unit. But I think that's likely to occur in the next 5 to 6 months, that phase of it. That is not the end of the bull. That's just the next thunderbolt. And during that time, I think silver will basically double in relative performance to what gold does during that time. Silver is definitely going to be the better place to be. And I don't think anymore. I think that occurred over the last year, as I explained, from May of last year up through June of this year. There was this momentum corrective process. And if you saw our charts, you would see what I was talking about. Momentum was revealing something that you couldn't see it on a price chart. On a price chart, you saw erratic behavior. It seemed to be trendless, yet net on balance, it was really sideways, either side of about $32, up, down, up, down, up, down. Momentum was building a structure, what we call a structure, meaning a definable chart pattern, in this case, a perfect parallel channel that spanned an entire year when momentum was correcting from pretty high levels down to neutral levels. And then it said, okay, out of here. And it's out of here. So I suspect basically about every month going forward, we're going to see silver dramatically higher than the prior month. And I think we're not going to pause at 50. Anybody who's waiting to sell it up there again, I think is going to get bulldozed. But I think this is not a behavior pattern that's unusual for many markets, not just silver, where after a lengthy upside where there's been arm wrestling a lot of the way, up and down, confusing a lot of people. These things happen. That's reality. Markets ebb and flow. They have waves of profit taking. The question is, which one is real, meaning sustainable? None of them have been for silver. None of them have been for gold, sustainable on the downside. Even that collapse we had in April, which took it from 35 to 27.50, was back up in the 30s in a heartbeat and then new highs within a month. Okay, so you've got, if you're invested in silver, don't look at the day-to-day stuff. Even looking at price itself can be delusional, but at least look at the longer-term trend and you'll see what I'm talking about, that this arm wrestling process doesn't go on forever. And most bull markets, you get a point where you go whoosh, and people are shocked by the sudden change in the demeanor of the market. It's not what they expected because they've been trained by the market action prior to expect this continued doubt process, going up yet in doubt. And then suddenly there's a jolt, and if you're not there, you miss it. And because it won't give you opportunities to enter. As far as we're concerned, basically all the opportunities to enter are well below us. But you better get in soon, because if we're correct, and I think we are, you're going to see this type of action, which will be surprising. And I bet it's correlated to certain other markets doing certain other things.
Price, he argues, is a flawed measurement tool because it's denominated in fiat currencies, units like the dollar, yen, or euro, that are continuously debased by central banks. A price chart doesn't just reflect the value of an asset, it reflects the decline of the measuring stick. That's why momentum, which analyzes the internal dynamics of price relative to moving averages, offers a better way to see the market. Momentum reveals structure, trend lines, ceilings, floors, channels. It tells you when an asset's behavior is changing before the price catches up. He rejects mainstream momentum tools like MACD and RSI, calling them wet noodles because they're generic and lack depth. His momentum charts are bar chart styled, technical, and focus on structural formations that can forecast future behavior with much higher reliability.
There's a philosophical there's a theoretical reason why momentum is better than looking at a price chart. First off, realize price is deceptive because the thing you're measuring by is a money unit, a fiat money unit, not backed by anything but BS. Whether it's the yen, the euro, dollar, they're all backed by nothing, okay? Government at the push of a button can increase its supply, artificially lower the cost of money, interest rates. And for the last 15 years, 10 of those years, we've had zero rates. Free money. I mean, how hallucinogenic can you get? Okay. And so it's a distorted yardstick. So if you're measuring something with a yardstick that is changing in real value year to year, especially every decade to decade, it's distorting the price reality. So you're looking at price is not the thing you're looking at, it's the distortion in the money unit could be more of a factor than the actual asset you're looking at, okay? Now, how do you factor that out? Well, you can't really because you measure it by a dollar, let's say. What we do is we take the momentum, meaning the dynamics of the underlying asset as measured by dollars. Many markets are dull. They're just going sideways. No momentum at all. They're just, up, down, trading range type thing. Strong markets or weak markets will often have sharply rising momentum dynamics or weak momentum dynamics. That factor, by using the momentum of the asset, even though it's somewhat distorted by the money unit, just like the price of the asset is, removes you a half a step away anyway from simply measuring by the money unit itself. You're letting one of the attributes of the asset do the talking. Okay. And when you plot momentum, meaning you oscillate the price action in relationship to a given moving average, let's say, long-term or short-term average, you'll get a different visual picture of that market quite often than you will when you look at the price chart. And almost all the time, at a major top or a bottom, momentum will have warned you ahead of time clearly in a way that smacks you in the face if you had the opportunity to see a momentum chart at the right time. We don't use the wet noodle indicators. Those are the things like MACD and RSI, which are on everybody's screen for free, part of the package. Ours are more bar chart oriented, like you would look at a price chart, but they're momentum based. And again, we're looking for structure on the momentum, not whether it's just going up or down. You can have an up move in momentum that's not bullish. It's just an up and a down pattern, okay? We look for structure, just like a price guy would. Is there a trend line? Is there a ceiling? Is there a floor? And if you're breaking it, because then momentum is saying, hey, I'm changing trend. And lo and behold, you look over at price and maybe it's not. Soon thereafter, it is, okay? Price usually follows momentum. That's what we do.
Please like and subscribe.